Welcome to the podcast, ES Midweek Update, your Wednesday appointment for cyclical and volume analysis on ES, the S&P 500 mini futures contract. I am Ryan Cooper, a financial journalist, and we are joined by expert analyst and trader Clara Bennett from Cyclical. Please note that the views presented in this podcast are generated by AI NotebookLM, that analyses and reprocesses are pre-market live sessions from the YouTube channel Cyclical, and therefore could contain errors. All references to price levels or market analysis are not to be considered financial advice. The aim of this podcast is to analyze market dynamics and provide a midweek update.
All right, let's dive into something pretty interesting today. We're looking at 3 pre-market trading sessions for the ES market. The S&P 500 mini futures. And get this, the U.S. market was actually closed for a presidential inauguration during this time. So talk about a unique time to analyze market behavior, to help us break it all down. We've got Clara Bennett with us from Cyclical. She's a trader who really knows her stuff when it comes to using cyclical analysis to understand the markets. Welcome to the show, Clara.
Thanks for having me. It's definitely an interesting time to be watching the markets.
You're telling me. Okay, so let's jump right into it. I'm seeing some buzz about bullish signals popping up in the quarterly and monthly cycles. And there's even talk about a break above that semi-annual horizontal resistance level. Can you break this down for us? What does it all actually mean, especially for someone who's maybe not a seasoned trader yet?
Absolutely. So when we look at market cycles, we're essentially looking for patterns in those price movements. Think of it like trying to understand the rhythm, the heartbeat of the market, basically. And right now, the longer-term cycles, like the quarterly and the monthly ones, they seem to be lining up in a way that suggests we're in for an upward trend. That break above the resistance level is important because it's like the market pushing through a ceiling that's been holding it back. It's a show of strength, and it could mean that we're going to see that upward momentum keep building.
It's like the market's flexing its muscles, right?
Exactly. And that's definitely something that traders pay close attention to. Now, you might be thinking, okay, great, everything's pointing up, time to jump in. But hold on, there's more to think about.
Oh, I love a good plot twist.
Tell me more. Well, we also have to factor in those shorter-term cycles. For instance, that 8-day cycle is expected to form a top pretty soon, and that could mean we might see a dip in the market.
Interesting. So even though the long-term outlook seems pretty bullish, there could be these shorter-term dips along the way. You mentioned waiting for that 8-day cycle to close before making any trading decisions. Could you walk me through what that would look like on a chart? What should I, as a trader, be looking for?
You want to see that the 8-day cycle has actually reached its peak and started to turn downward. This confirmation helps us avoid buying at the very top right before a potential drop. Think of it like waiting for a wave to crest before you try to catch it for surfing. Timing is everything.
Patience is key. It's not just about seeing that upward trend, but understanding the nuances of those shorter cycles within the trend.
You got it. Now, this is where things get even more interesting. The 4-day cycle is also in the mix, right? And it's sending some mixed signals. This is where we have to put on our detective hats.
Ooh, I love a good mystery. Okay, you've got me curious. What's going on with the 4-day cycle?
Well, the way those 4-day cycles are sequencing, specifically the 123, 345, and 567 sequences, they can give us clues about the overall market direction. And what we're seeing right now is a bit of a conflict. The 4-day cycle sequence is hinting at a bearish projection, which seems to clash with that bullish sentiment from the longer-term cycles we just talked about.
Okay. So we've got this kind of tug-of-war happening. On the one hand, the longer-term cycles are painting a pretty positive picture. But then we have this 4-day cycle potentially throwing a wrench into things. How do we make sense of this? What's the most important takeaway here?
Well, that's the art of cyclical analysis, right? It's not always a straightforward answer. We have to consider all these different cycles and how they interact with each other.
It's like piecing together a puzzle, looking at all these different pieces to get that full picture.
Exactly. And here's what's really fascinating. This 4-day cycle might actually be a 3-day cycle in disguise.
The 3-day cycle in disguise. Okay, you've got to break that down for me. What evidence leads you to that conclusion?
Well, sometimes those cycles deviate a little bit from their expected durations, in this case. The characteristics of what we're seeing in the 4-day cycle align more with what we typically see in a 3-day cycle.
So even the cycles themselves can be fluid. They can change over time.
Exactly. It's why we're always reevaluating and adjusting our analysis as we get more information.
I'm starting to see why you're known for your work in cyclical analysis. It's a whole new way of looking at the market. And to make things even more interesting, you mentioned that you're also seeing signs that the 8-day cycle might actually be a 6-day cycle. How did you arrive at that conclusion, and why is this distinction important?
Well, if it is a 6-day cycle, that dip we talked about might come sooner than we initially thought. It shifts our timing and potentially creates some opportunities for traders who are paying attention.
Okay, so understanding these cycles and their potential shifts can give traders a real edge.
Absolutely. And we can't forget about volume analysis. We saw some pretty high volume during that recent break above 59.40.
For our listeners who might be new to this, can you explain why volume matters? What story is it telling us?
Sure. High volume often acts like a confirmation signal. It shows us that the market is truly committed to a move. Think of it like this. If you see a small group of people walking down a street, it might not mean much. But if you see a huge crowd all moving in the same direction, you know something big is happening.
So it's like a vote of confidence from the market.
Exactly. And in this case, that high volume during the breakout above 59.40 reinforces the idea that the market is likely to continue its upward trajectory.
It's like the market's sending us a pretty clear signal. Now, I've heard some talk about a coffee cup formation. Can you demystify that for us? What does that look like on a chart, and why should we care?
Imagine a cup with a handle on the right side. The price forms a rounded bottom, like the cup, and then pulls back a little to form the handle. And when that price breaks above the handle, it often signals a surge upward, as if the cup is being tipped over and spilling its contents.
So we're looking for that tip-over moment to confirm the continuation of the upward trend. Now, I want to focus on yesterday's trading session for a moment. There was a moment when the market seemed headed for a downturn. But then, it made a pretty dramatic surge upwards. You were watching this all unfold in real time. What were you seeing?
Well, it was a classic example of market psychology in action. We saw some initial selling pressure, and it looked like the market might break down. But then buyers stepped in aggressively, absorbing all that selling and pushing the price right back up. It was like someone flipped a switch.
So how did you read that moment as a potential entry point for trades? What were the key clues you were picking up on?
I was watching those volume patterns very carefully. As buyers started to overwhelm the sellers, the volume spiked. And that's a signal of shifting momentum. It suggested fear was subsiding and confidence was returning.
It's like you were reading the market's mind. You weren't just looking at the numbers. You were understanding the emotions behind them.
That's what makes trading so fascinating. It's about deciphering the psychology of the market, understanding what's driving those price movements.
All right, we're going to dive even deeper into yesterday's trading session right after this. Stick with us as Clara walks us through some of the key moments and shares the insights she gained from watching the market's behavior. Don't go anywhere. So, Clara, you were talking about that moment yesterday when it seemed like the market's mood just completely shifted. What happened next? What really stood out to you as the trading session went on?
It was all about those buy orders hitting the market. That's when I knew things were turning around. It wasn't just the volume going up. It was the force behind those buys. That really signaled a change in sentiment.
For someone like me,
Huh?
still trying to learn all the nuances, how can I get better at spotting those subtle shifts in market psychology?
It's kind of like being a detective, you know? You got to look for clues. In this case, the aggression behind those buy orders was a big tell. It showed a level of conviction that wasn't there before.
So it's not just about seeing buy orders. It's about understanding the story those orders are telling, about how other traders are feeling.
Exactly. And don't forget, yesterday was a shortened trading day because of the inauguration.
Right. So we can't read too much into one day's performance, especially given those unique circumstances.
True. But we did close near the top of the day's range, and that does point to continued buying pressure.
So even in a short session, those bulls were making themselves known.
It seems that way. But as we head into the rest of the week, things could get more interesting. How the market digests the new administration's policies is definitely something to keep an eye on.
Yeah, policy announcements can definitely shake things up. It makes sense that traders would be feeling a bit on edge, especially during a transition like this.
Uncertainty often leads to volatility, and that's something every trader needs to be ready for.
So for our listeners who might be feeling a bit uncertain themselves right now, what advice would you give them? How can they handle this potential volatility?
Well, first and foremost, stay informed. Keep a close eye on news and events that could affect the market. Knowledge is power when it comes to trading. Second, don't bite off more than you can chew, Manage your risk carefully. And think about using tools like stop-loss orders to protect your capital. And third, don't let your emotions make your decisions for you. Wait for those confirmation signals before jumping into any trades.
Solid advice, Clara. Now, I want to step back for a minute and look at the bigger picture. We've been in a bull market for a while now. Are there any warning signs that this party might be coming to an end?
That's the million-dollar question, isn't it? No one has a crystal ball. But there are some indicators we can watch. For example, rising interest rates are something to pay attention to because they can make it more expensive for companies to borrow money, which can impact their profits and potentially put some downward pressure on stock valuations.
It's like a ripple effect across the economy.
Exactly. Inflation is another thing to watch closely. If it heats up too quickly, it can eat away at company profits, and that could potentially lead to a market correction.
So essentially, we're looking for any signs of weakness in the economy. That could throw the bull market off track.
That's right. And it's important to remember, markets are cyclical. Bull markets, no matter how good they feel, don't last forever. Bear markets are a natural part of the cycle.
So it's not about fearing the end of a bull market. It's about understanding it's a normal part of how the market ebbs and flows.
Absolutely. And knowing those cycles, being able to anticipate them, that's what gives traders an edge.
This is all incredibly insightful, Clara. It's like you're giving our listeners a secret decoder ring for the market. Before we wrap up, I want to circle back to something you mentioned earlier, that potential conflict between the 4-day and 8-day cycles. Can you unpack that a bit more for us? What does that conflict actually look like, and what should we be watching for?
Of course. Remember, the 4-day cycle sequence is hinting at a bearish move, while those longer-term cycles we discussed, and the overall sentiment, still seem bullish. So it creates a sort of push and pull in the market.
It's like a tug of war. Which cycle do you think will win out?
That's tough to say for sure. That's why we look for those confirmation signals. For example, if that 4-day cycle keeps weakening, it might be enough to drag the market down, even with those bullish longer-term cycles still in play.
So, it's a good reminder to always look at both the short-term and long-term cycles to get a complete picture of what the market's telling us.
That's the key. Think of it like navigating a ship. You need to pay attention to the immediate waves, but also the overall current. Ignoring either one could steer you off course.
That's a great analogy. It really highlights the importance of having a well-rounded approach to market analysis, using multiple tools and perspectives.
Absolutely. The more information you have, the better equipped you are to make smart, informed decisions.
This conversation has been really eye-opening, Claire. I feel like I'm starting to see the market in a whole new light now. To tie everything together and leave our listeners with something to ponder. You mentioned that 4-day cycle sequence and its potential bearish lean. Can you walk us through what that looks like on the charts and what kind of scenarios might play out over the coming days?
Sure, let's take a closer look. So when we examine the recent price action within that 4-day cycle, it's suggesting that we might be in what we call the 567 phase of the sequence. You can think of these sequences as like mini chapters within the cycle. And this particular sequence, the 567, tends to be a little weaker, often leading to a pullback before the next cycle gets started.
So even though we have that broader bullish backdrop, this 567 sequence within the 4-day cycle could act like a speed bump, right?
Yeah.
Temporarily slowing things down a bit.
Exactly. So here are a couple ways this could play out. One scenario is that the market respects this 4-day cycle sequence, and we see a pullback as it finishes that 567 phase. Now, this pullback could actually be a buying opportunity for those who are bullish in the long run.
So it's like a chance to buy the dip before that upward trend picks back up again.
Precisely. The other scenario is that the market basically just ignores this 4-day cycle sequence and keeps surging higher, driven by that momentum from the longer-term cycles and that overall bullish sentiment we've been talking about.
So in that case, the bulls would be in control, and anyone trying to bet against the market would be in for a rough time.
That's right. Of course, we can't predict the future with 100% certainty, but by understanding these cycles and watching the price action, we can get a better idea of which scenario is more likely to happen.
It's all about being observant, adaptable, and making sure our strategies are aligned with what the market's telling us.
Couldn't have said it better myself. And that's why cyclical analysis is such a useful tool. It gives us a framework for understanding how the market behaves, so we can make more informed decisions.
Clara, this deep dive into the ES market has been absolutely incredible. I feel like I've learned so much. Thank you for sharing your expertise and insights with our listeners today.
My pleasure. Hopefully, this will help everyone feel a bit more confident as they navigate the markets.
And for our listeners, I want to leave you with one final thought. Clara mentioned that 8-day cycle that might actually be a 6-day cycle. So think about this. If that's true, how could that affect the timing of that expected dip? That potential buying opportunity we talked about. And the next surge in the ES market. Something to think about as you watch the market this week. Happy trading, everyone.
Thank you for listening to the podcast ES Midweek Update. Subscribe to the Cycle Depth channel to stay tuned for the next episodes and leave a comment. We remind you that the opinions expressed in this podcast are generated autonomously by AI NotebookLM, based on our pre-market live sessions of the U.S. market, and therefore, the content might not fully reflect objective market data or the analyses from our live sessions. This podcast is not financial advice. A greeting from your host, Ryan Cooper, and we'll see you next Wednesday.